There's a company you've probably never heard of that gets paid every single time you buy an index fund. It doesn't run the fund. It doesn't pick the stocks. It doesn't hold a dollar of your money. It just owns the list of stocks the fund is required to track. And right now, that list, and a few dozen others like it, have $18 trillion of global capital riding on them. $18 trillion. That's the total AUM benchmarked against MSCI indexes worldwide as of December 2025. To put it in scale, it is roughly 8 times the AUM sitting in ETFs that license MSCI indexes directly, tracked, measured, and paid for through a single company headquartered in New York that most retail investors couldn't name in a lineup. Here is how the toll booth actually works. MSCI builds an index, the All-Country World Index, the EAFE, the Emerging Markets Benchmark, and dozens more. An asset manager like BlackRock, Vanguard, or Amundi decides to launch an ETF that tracks one. To do that legally, they sign a licensing deal. And critically, they do not pay a flat fee. They pay a royalty, a basis point cut of every dollar of investor money sitting in the fund. The market goes up, their AUM goes up, MSCI's check goes up, automatically, no phone calls, no renegotiation, no salesperson required. As of December 2025, $2.3 trillion sat specifically in ETFs linked to MSCI equity indexes. Every single basis point of that is a recurring royalty, paid quarterly, with effectively zero incremental cost to MSCI for each new dollar that walks through the door. This is the cleanest revenue stream in modern finance. And the receipts prove it. MSCI's total operating revenue went from $2.04 billion in 2021 to $3.13 billion in 2025. That is a 53% jump in 4 years. Last year alone, the top line grew 9.7% in a business that mostly just sits there and licenses lists of stocks. Now look at the margin. MSCI's GAAP operating margin for full year 2025 was 53.5%. The adjusted EBITDA margin hit 60.8% in the fourth quarter of 2024. GAAP operating income alone came in at $1.71 billion on revenue of $3.13 billion. Net income, $1.2 billion. These are not normal numbers. Most software companies would sell their CEOs to post margins like this. Here is where the business model becomes impossible to miss. Of MSCI's revenue in 2024, 55.9% came from the index segment, the licensing operation. Analytics was 23.6%, ESG and climate 11.4%, private assets the remaining 9%. The index licensing engine pulls the train. Everything else is a sidecar bolted on. And this is the quiet monopoly thesis stated plainly. The best businesses in the world do not compete on price. They do not compete on innovation cycles. They do not even compete on customer service. They sit at a structural choke point in a much larger industry, charge a small percentage, and let other people do the actual work and take the actual risk. MSCI did not build the ETF revolution. It just owns the road every passive fund in the world has to drive on. How entrenched is this position? In Europe, MSCI accounts for 47% of all passive equity fund assets, the largest single provider on the continent. Roughly half of every euro indexed into European stocks pays a small recurring toll to one American company most Europeans could not name in a lineup. Globally, the picture looks more competitive at first glance. S&P Dow Jones leads with 33.8% of global equity ETF assets. FTSE Russell holds 11.3%. MSCI takes 9.5%. And in the U.S. specifically, the Big Three combined control roughly 80% of the entire ETF market. This is not a monopoly. It is a three-player oligopoly with an unbreakable moat, and MSCI owns the international leg of it. Drill into the index segment and 41.2% of its revenue is that asset-based royalty, the part that grows automatically when markets rise. That is the flywheel. Stocks go up, AUM goes up, fees go up. MSCI's index segment annualized run rate hit $1.9 billion at the end of 2025, up 16.2% year-over-year. The flywheel is accelerating. The other half of MSCI's business is subscriptions, terminal access for analysts, data feeds for risk managers, ESG ratings for funds. The retention rate on those was 95.3% in the first quarter of 2025. Customers do not leave. Once an asset manager has built a product around an MSCI benchmark, Switching means relaunching the fund, refiling prospectuses, explaining the change to shareholders, and watching the historical track record split into two pieces. Nobody bothers. And here is the part that makes the business genuinely strange. MSCI does not own a single share of stock. It does not run a single fund. It carries no balance sheet exposure to market drawdowns the way an asset manager does. When markets crash, BlackRock loses fee revenue, each redemption hits, and gets headlines about outflows. MSCI just earns a slightly smaller royalty on a slightly smaller AUM base. And when markets recover, and they always do, the royalty quietly grows again. The press never even mentions it. $44.6 billion in market cap for a company most retail investors could not pick out of a lineup. That is the quiet monopoly pattern in one ticker symbol. The loudest brands in finance, the asset managers, the brokerages, the trading apps you see advertised at sports games, are not where the real economics live. The real economics live with a company that quietly built the rails, licensed them out, and now just collects basis point by basis point year after year as the world's wealth compounds. If you want more breakdowns of the businesses hiding in plain sight, subscribe. We find the toll booths everyone else missed.